Hi friends, good evening.
Good evening, sir.
Good evening,
Good
sir.
evening,
Good
sir.
evening, sir.
Good evening, sir.
Good evening, sir.
Yeah, very good evening. Shall we start?
Yes,
Yes,
sir.
yes. So now we are in the second session of the Group 2 accounts R2E, right? So here with today's session, short session, we'll be planning to focus on 4 chapters. Out of the 6 chapters in which I handle, 4 chapters are done, right? We have Buyback, Esop, Nbfc and Dissolution of Firms. These 4 chapters are done. Amalgamation and liquidation, we'll do it a little later. It's okay. We can once the chapters are done in the next set of revisions, we can cover that. Okay. We'll start with the first chapter, Esop, Employee Stock Option Plan. In case of employee stock option plan, the main point that we have to focus is those 3 terminologies. Which are those 3 terminologies? Vesting period, exercise period, and lock-in period. What is vesting period? Vesting period is the time period which an employee has to wait to be eligible for the stock options, right? So the eligibility period, that is the vesting period. Exercise period is once that employee became eligible for the ESOPs, he will be given certain time limit to exercise, to pay that nominal amount and exercise for the options. That time period is called exercise period. Once the shares are allotted, there will be a restriction for him to sell the shares for a certain period of time. That is called lock-in period. Right? So these are the 3 different categories, 3 different terminologies, very important, can be asked in the exam, right? Vesting period, exercise period, and lock-in period. Now, from the accounting point of view, we are only bothered about the vesting period because the expense, which we call employee compensation expense, that would be apportioned in the company as expenditure over the vesting period. Correct? It will be apportioned over the vesting period. So for that, first we need to find out the total compensation expense. How do we find out the total compensation expense? For that, we want the intrinsic value or fair value. What is intrinsic value or fair value? The present market value of the shares minus exercise price. The amount or the price contributed by the employees, exercise price. With that we get the intrinsic value or fair value. In exams, they might give you directly the intrinsic value or fair value, or in certain cases they might give you both in the sense market value, exercise price, as well as intrinsic value or fair value. In certain cases, that market value minus exercise price and the intrinsic value or fair value given in the question might be different, might be totally different. They say due to certain market restriction, the fair value of the company, the intrinsic value or fair value of the company, so and so. In such case, we need to go with the intrinsic value or fair value given in the question. We should not subtract exercise price from the market price to get the intrinsic value or fair value. If intrinsic value or fair value is given, we should go with the intrinsic value or fair value given in the question, irrespective of whether the information related to exercise price and market price is given or not. However, if intrinsic value or fair value is not given, in that case, we have to go with market price minus exercise price. Is that clear? Yes. Okay. Next. So once that is done, once we have the intrinsic value or fair value, that has to be multiplied with the total number of options expected to vest at the end of year 1. That is, at the end of year 1, we have to check what is the total number of options that are expected to vest. So based on an estimate, we will recognize the expenditure at the end of year 1. Again, there could be 2 different types of problems that can be asked. One is everything happens in one single financial year itself. The vesting period, exercise, as well as allotment happens in that financial year itself. In that case, we need not bother about what is the total number of options that would vest at the end of the year. Based on that itself, we will recognize the expenditure in that year itself, allot the shares. Whereas in most of the cases, vesting happens over the years, right? After 2 years, 2.5 years, 3 years. In such cases, at the end of year 1, we should go with an estimated number of options that will vest. How do we get that? In the question itself, they would have said at the end of year 1, so many options got lapsed. At the end of year 2, so many options got lapsed. At the end of year 3, so many options got vested. Out of that, some options got lapsed before the exercise period, right? There would be year-wise information given. Based on that, we need to estimate on a yearly basis. First year, if the vesting period is 3 years, first year based on the number of options into intrinsic value divided by 3 is the first year expenditure. Second year, go with the revised estimate based on the number of options which are vested into the intrinsic value into 2/3 gives you the total expenses for 2 years minus the expenditure that you have already recognized in the year 1 would be the balancing figure would be the expenses to be recognized in the second year. And third year, again, we have to do the same thing. Right? That is how the expenses to be recognized in case of ESOP works. That's all. These are some of the points that we had to focus on. We'll quickly look into the material. Anyhow, we'll look into some of the questions also later. Yeah, ESOP. ESOP means stock options offered to employees either at cost or a concessional rate. Main objective is to reduce labor turnover. So what is lock-in period? Minimum period for which employee has to stay in the organization. This is not lock-in period, this is vesting period. To avail the benefit of ESOP, benefit given to the employees shall be treated as deferred staff welfare expenditure and same shall be amortized to P&L over vesting period. So we have an example here. 1 lakh options given to employees at 40 rupees per unit. So what is this 40 rupees?
Exercise price.
Very good. Exercise price. 40 rupees is exercise price. Fair market value is given. Now, we should not get confused with between fair market value and fair value. Both are different. Fair value is the difference between fair market value and exercise price. Correct? So we should not get confused there. Then vesting period is 3 years. Total employee benefit or staff welfare is FMV minus Z. We get intrinsic value, which is 120 rupees, 160 minus 40 into total number of options, 1 lakh. 1 lakh into 120, 120 lakh is the total expenditure. Correct? 3 year vesting period. So divided by 3, every year 40 lakh per annum. So first year I will recognize 40 lakh rupees. Right? That is expenses to be recognized. Now, in case of listed companies, they have SEBI regulations as well, apart from 62(1)(b) of the Companies Act. Unlisted companies, we go with 62(1)(b) of the Companies Act and Rule 12 of companies, share capital and debentures rules. Okay. Now, for ESOP, special resolution is compulsory. Special resolution is compulsory. What does Rule 12 of company share capital debenture rules say? Not so important. However, we'll have a look. Employees does not include independent directors. Again, we will discuss this in detail in CA final company law. Right? Employees does not include independent directors. So independent directors are not eligible for ESOPs. An employee who is a promoter or belongs to promoter group and director who directly or indirectly holds more than 10% of the outstanding equity shares. What is the minimum vesting period? Minimum vesting period should be 1 year as per the rules. As per rules, minimum vesting period 1 year. They are free to determine exercise price. Exercise price, there is no restriction. Even shares can be allotted at discount if it is a ESOP allotment, right? Apart from that, the discount shares cannot be allotted only in case of ESOPs. So exercise price, company is free to determine. It can be 0 as well. Freedom to determine lock-in period also. Lock-in period also, there is no restriction. Separate resolution to be passed in case grant to employees of holding or subsidiary company. Non-transferability of ESOPs. Now, ESOPs have been allotted to you. You cannot say that I do not want, I'll transfer it to some other person. If you remember group 1 rights issue, renunciation of rights, that is not possible in case of ESOP. Right? That is not possible because this is given to you since you are an employee. If you want, you accept, else you reject. That's all. Unvested ESOPs to vest in case of death or permanent incapacity, disclosure of prescribed details in director's report, maintenance of ESOP register. Company has to compulsory maintain a register called ESOP register. We need not bother much about these rules. In accounts, not so important. That's all. This is about ESOP. Then we'll move on to the next chapter. And then once we are done with all the 4, we'll look into some of the questions. Okay. Next chapter is buyback. Now, with regard to buyback, what are the sections in Companies Act which talks about buyback?
68, 69.
68, 69 and 70. 68, 69 and 70. Very good. Okay. Now, buyback can be out of 3 things.
Free reserve, securities premium.
Yes. And?
Fresh issue of equity shares.
Perfect, perfect. Fresh issue of shares. Proceeds from fresh issue of shares. Right. Free reserve, securities premium and fresh issue of shares. For buyback, the law provides certain conditions, right? 3 tests have to be satisfied. We call it 3 tests, right? Resource test, shares outstanding test, and debt equity ratio test. Resource test is 25% of
total paid up capital plus free reserve.
Paid up capital plus the free reserve. So resource test is focusing on the total buyback amount. Right? Paid up capital plus free reserve into 25%. Next, the shares outstanding test is 25% of
Total outstanding.
Total shares outstanding. Correct. Total shares outstanding. So here we are mainly focusing on the number of shares. Third test is debt equity ratio. It says the total of debt cannot exceed 2 times the
Equity plus free reserves plus securities premium.
paid up capital plus free reserves, right? 2 times of paid up capital plus free reserves. Not securities premium. Yeah, free reserves. We'll consider securities premium also in case of buyback, right? In case of buyback, we consider securities premium as well. 2 times of paid up capital plus free reserves, not the entire share capital and reserves and surplus. Correct? Right. Now, if all these 3 conditions are satisfied, then only buyback is possible, right? If with regard to the questions in the examination, we can expect them to ask question asking first whether the buyback is satisfied or not, whether buyback is permissible or not. In that case, we have to go with these 3 tests and check whether buyback is permissible or not. However, if they are asking us just to pass journal entries, then we are presuming that it is satisfied, right? It is better if possible you write a note stating that if the thing is given in the question, write a note stating that it is presumed that all the 3 tests have been satisfied. Therefore, journal entries have been directly. We are starting with the journal entries. However, even if we forget, nothing to worry. Okay, even if we don't write that note, nothing to worry. We can directly start with the journal entries. Now, if buyback is made from free reserves and securities premium, I have to create what?
ERR.
Redemption reserve. Now, this capital redemption reserve to be created, what to the extent of what is the amount of CRR to be created?
Nominal value.
Nominal value of the buyback. Correct. Nominal value of the buyback. So, if the buyback price is 20 rupees, I'll create CRR only to the extent of 10 rupees, which is the nominal value. Right? So CRR to be created only to the extent of nominal value. This we have to keep in mind in some cases where we have to find out the number of shares, maximum number of shares that can be bought back. There we have to create an equation, right? X will be considered as buyback, Y will be considered as the nominal value, right? If we remember. So such kind of questions we have to be a little careful there. Okay, these are some of the points in case of buyback. We'll quickly look into if we have missed any of the points. Yes, authorized by articles. Buyback can be out of free reserve, securities premium, free issue of other securities other than securities to be bought back. Maximum possible buyback is 25% of PUC plus FR. Maximum buyback is 25% of outstanding shares. Post buyback, ratio of debt to PUC plus FR should not be more than 2. Yes, this debt equity ratio test is post buyback. Post buyback test. This test have to be satisfied after the buyback. Up to now normally special resolution for buyback. However, if the buyback is up to 10%, board resolution is sufficient. Board resolution is sufficient. Ratio prescribed in point number 4 above is not debt equity ratio. It is not, we call it debt equity test, but it is not debt equity ratio because it doesn't include all the equity items. It only includes paid up capital plus free reserves. Yes, free reserves include securities premium for our discussion in this chapter. And debt here includes securities premium plus, secured loans plus unsecured loans, both short term and long term. Very important. We might miss debt in the sense we might only focus on long term debt. No, long term debt, short term debt, in that both secured and unsecured all are covered. Is that clear? Yes. Now, once a buyback is done, for the next 1 year, another buyback is not possible. Buyback premium should be debited to general reserve. Now, can we use securities premium to write off buyback premium payable on buyback?
Yes, sir.
Yes. Now, with regard to utilization of securities, there are 3 scenarios for us. In group 1 accounts, we have discussed what?
Differential.
Shares and bonus issue. Correct. And in case of group 2, we have buyback. Now, with regard to buyback, easy to remember, with regard to buyback, since it is in group 2, no restriction. No restriction. Whereas preference shares and bonus issues, since they are in group 1, there are restrictions. There preference shares, it is applicable only to those companies, or basically we cannot use securities premium for those companies which are covered, certain specific companies which are covered under section 133 of the Companies Act, etc. So in ICAI, all companies are covered under that. So preference share redemption, securities premium, not at all possible. Right? We will not go ahead with that. With regard to bonus issue, there are 2 things. In case of a listed company, Bonus issue can be done only if it is
Collected in cash.
collected in cash. Yes, only if it is collected in cash. These are the restrictions that are there. But in buyback, we need not bother about. We can use securities premium for the purpose of buyback itself directly, right? Buyback out of free reserve, securities premium, and proceeds. So since that is the utilization available, we can directly go with buyback or utilization of securities premium without any restriction. Then 69 says whenever you are going for buyback out of free reserves or securities premium, equal amount have to be transferred to CRR. Equal amount in the sense nominal value. Nominal value, and CRR can be used obviously only for bonus issue, not beyond that. Then, okay, next one is that is about buyback. Next is equity shares with differential rights. Same chapter, we had a separate unit called equity shares with differential rights. Now, when we talk about the different types of share capital, we have two types: equity share capital, preference share capital. Preference share capital does not have any further categories, full stop. Whereas equity share capital has two different categories: equity shares with normal voting rights, equity shares with differential voting rights. Right? The differential voting rights can be with regard to dividend, voting, or otherwise. Right? The differential right could be with regard to anything. There could be a separate distinction between that particular class of equity shares and other class of equity shares. So the underlying principle here is there cannot be differential differential rights with regard to preference shares, right? It can be a question in the exam, can be asked. So differential rights cannot be issued in preference shares, only equity shares, right? Then with regard to preference shares, that is one point that we have to keep in mind there. Apart from that, from that particular discussion, one practical question can be asked where equity shareholders and preference shareholders both are eligible to vote. We need to calculate the proportional voting rate, right? For that, before going with that practical question, there could be a theory question stating when preference shareholders have voting rights. We had several categories, several circumstances, right? One, when their rights are affected in case of winding up of the company, then when there is a reduction in capital or repayment of capital. In those three cases, apart from that, when there is non-payment of dividend for 2 years, then preference shareholders have voting rights in all resolutions, not only the above three scenarios, right? So this is the list which can be again asked in the exams. Apart from that, if they are eligible to vote, they can ask us to calculate proportional voting rights. How to do that? Based on the paid up capital of equity shares plus paid up capital of preference share. From that, we need to calculate the weights that we have to allot to the votes of equity shareholders, votes of preference shareholders. Based on that, we can calculate the proportional voting rights. Correct? That is what we had discussed in differential voting rights. We'll quickly look into the material. Yeah, 43 allows companies to issue equity shares with differential rights as to dividend, voting, or otherwise. Here, otherwise is the residual category to give leeway to the management in structuring the shareholder agreement with the desired divisions of managerial control and financial interest. So it can be anything. We need not bother. Preference shares with differential rights cannot be issued. Very important point. It is only equity shares which can be issued. Types of share capital: equity shares with voting rights, with differential rights as to dividend, voting, or otherwise, and preference shares. Blanket rule is 1 share, 1 vote. That is why the exception is this differential voting rate scenario, where 1 share can have more than 1 vote or less than 1 vote also. But sometimes a segment of shareholders may have to more control over decision-making process. This intention can be activated if they have more voting rights, even if they hold fewer shares. This can be structured by giving them shares with superior voting rights. So restrictive voting rights to preference shareholders. Preference shareholders can vote only on resolutions placed before the company, which directly affect the rights attached to preference shares. Any resolution for winding up of the company, for repayment or reduction of equity or preference share capital. However, if dividend is not paid for 2 or more years for preference shareholders, then they have the right to vote on all the resolutions placed before the company. Proportion of voting rights of equity shareholders to voting rights of preference shareholders shall be in the same proportion as paid up capital of equity shares bears to paid up capital of preference shares. Right? So we have to focus on the paid up capitals. Now, again, there is rule 4 which talks about the conditions to be complied at the time of allotment of differential rights, shares with differential rights. Again, authorized by article, ordinary resolution. Shares of differential rights cannot be allotted more than 26% of the total paid up capital. Out of the total paid up capital, 26% max. Company shall have consistent track record of distributable profits for last 3 years. Company has not defaulted in filing financial statements, annual returns for 3 years. Company has no default. That is a common point. No default in payment of dividend, deposits, debentures, and interest on the same. And not defaulted in dividend of preference shareholders, repayment of term loan from public financial institution, etc. And not penalized by court or tribunal in the last 3 years. And once there are these points, these conditions may or may not be asked. Okay, may or may not be asked. However, subsequent conversion of existing equity shares with voting rights into differential rights, is it possible? The answer is no. Now we have a normal voting right equity share. Normal voting right equity share. Can I convert it into a differential voting right equity share? The answer is no, not possible. Similarly, I have differential voting right equity share. Can I convert it into a normal voting right equity share? Not possible. Right? Both scenarios not possible. Then the above rules are not applicable to private companies. So private companies are free to structure. For them, they have no conditions. They are free to structure. Next, in that itself, we had a separate discussion for variation of shareholding rights. When can the shareholders' rights be varied? That is under section 48. Provision is contained in MOA or AOA. If it is not contained in MOA or AOA, then if such variation is not prohibited by the terms of issue of that class. Now, for variation in the rights of the shares, what we have to do? 3/4 of the holders of such share should give their consent in writing, or special resolution has to be passed for that separate meeting of such shareholders only. What is this variation of shareholding rights? We have rights given to the shareholder. We have equity shares allotted. They have some rights. Now, out of these rights, one of the rights we have to change. We have to alter. We have to alter. In such case, we have to follow this procedure. Now, this equity shareholders, there would be a separate class. This is a separate class of equity shares. I'm not calling the general meeting of all the members. I'm only calling the meeting of these shareholders. In this shareholders meeting, you pass a special resolution. Or if it is not possible to call the meeting, you obtain 3/4 shareholders consent in writing. If they give a written consent, then you can alter the shares. Is that clear? Now, if alteration of one class of share affects another class of shareholders, then you have to obtain 3/4 approval of that other class also. Now, this change in shareholders' right will come into effect if 3/4 or 75%, that is special resolution, if 3/4 of the shareholders agree. Correct? If 3/4 of the shareholders agree, then that variation will come into effect. Now, what about the balance 25% shareholders who have disagreed to it? Those who have disagreed to it, they have an option to exit, or they can apply to NCLT to have the variation cancelled. However, minimum number of people who have to apply is 10%. Out of 25, there 10% of the people who have disagreed, they can apply to NCLT to get the variation cancelled. Clear? Again, small discussions which may be asked, not so important. However, that practical question with regard to proportional voting rate calculation is very important, right? Very frequently asked in the exams. So this is the second chapter. We are done with buyback and differential rights voting shares. Then third chapter, NBFC, simple chapter, non-banking financial companies. There, which are non-banking financial companies? For point number 1, they are incorporated under Companies Act, right? They are companies incorporated in Companies Act. Second, having principal activity being financing activities. However, even if the principal activity is not financing activity, certain companies are deemed to be NBFC if they satisfy 50-50 test. 50% of the total assets are financial assets, 50% of their total revenue is from financial assets, from those financial assets. If those two conditions cumulatively are satisfied, then they are deemed to be NBFCs. Correct? Now, with regard to NBFCs, based on their operations, there are different kinds of NBFCs. We are not bothered about that. Based on whether they take deposits or not, we have two different categories of NBFCs, which are those deposit accepting NBFCs, non-deposit accepting NBFCs. Deposit accepting NBFCs, since they accept deposits from public, always important. Whereas under non-deposit accepting NBFCs, based on their asset size, if the asset size is greater than or equal to 500 crore, we call them systematically important non-deposit accepting NBFCs, else we call them non-systematically important non-deposit accepting NBFCs. Why this is important? Because the prudential norms, the regulations, etc. depend upon whether they are systematic or non-systematic. Similarly, provisioning also depends on whether they are systematic or non-systematic. The provisioning requirements, correct? Then we discussed about important discussion is with regard to calculation of net owned funds. For that, we need to first calculate owned funds. How do we calculate owned funds? In the share capital, I'll consider equity share capital and compulsory convertible preference shares. Right? Yes, compulsory convertible preference shares. Then in reserves and surplus, I'll take free reserves, I'll take securities premium. Can I take capital reserve?
Representing profit on sale of
assets. Yes, very good. Representing the sale of assets, right? The capital reserve can be considered. Revaluation reserve not to be considered. Then you have to reduce the losses, if any, deferred expenses, if any, and intangible assets. Right? These are the deductions. With that, we get the owned funds. Once we have owned funds, we have to reduce some more to get net owned funds. What are those reductions that we have to do? That is simple. Investment in shares as well as debentures, loans, advances, etc. in subsidiaries or group companies, and investment in shares only of other NBFCs. In case of investment in other NBFCs, we are not bothered about investment in debentures, loans, and advances. Those things should not be considered. Investments in debentures, loans, and advances of only subsidiaries and group companies should be considered. Clear? Now, once we have computed these two, we are adding up, but we are not deducting the entire amount. Only to that extent which exceeds
10%.
10% of owned funds. Right, 10% of the own funds. Only to the extent it exceeds 10% of the own funds, we will be reducing it from the own funds to get net own funds. Is that clear? Yes? Right. So that is calculation of own funds, net own funds, very important. Can be asked in the exam. Then we looked into classification of assets. The loans and advances are classified as standard assets, substandard assets, doubtful assets, and loss assets. Right? Standard asset, no default or NPA up to 1 year. Substandard assets are those assets which have been classified as NPA beyond 1 year. Doubtful assets are those assets which have been classified as substandard beyond 1 year. 1 year in the sense 12 months is the term that is used in the law. Right? Loss assets are those assets which have been identified as non-recoverable by the NBFC itself or RBI or internal auditors, external auditors. Correct? This is the categorization. Again, categorization can be asked. Classification of assets could be a separate practical question, or beyond classification. Once classification is done, why do we go with this classification? For provisioning. For provisioning. So provisioning related questions can also be asked. With regard to provisioning, only in case of standard asset, we have two different provisions for small NBFCs and big NBFCs. Apart from that, all provisioning remain the same. For small NBFCs, what is the provisioning for standard asset?
0.4%.
0.25. Pratibha. For small NBFC, 0.25. For big NBFC, 0.4. Yes, 0.4. Then in case of substandard assets,
10%.
10%. Correct, 10%. In case of doubtful assets, we have again two categories: secured and unsecured. Unsecured, 100%. Then again, depending upon the years of classification, up to 1 year,
20%.
10 plus 10. Substandard was 10. Increase it by 10. So 10 plus 10, 20%. 1 to 3 years,
30%.
30%. Again, increase by 10. 20 plus 10, 30%. Beyond 3 years,
50%.
50. 20 plus 30. First category and second category add up, we get 50%. And loss assets,
100%.
100%. Correct? 100% is the provisioning. So these are the provisions that we have to make. These are the percentages which we have to remember again. Now, this is for all loans and advances except hire purchase and lease. For hire purchase and lease, they have a separate provisioning requirement. Right? Hire purchase and lease, they have two different categories of provision: normal provision and additional provision. Normal provision, how do we calculate? Total outstanding dues. That is, at this time, whatever installments which is not paid, plus all future installments. All future installments. That is a total outstanding dues. From that, I have to reduce unmatured finance charges. What is unmatured finance charges? The interest income from today's, or rather for all the future installments. Interest income for all the future installments is unmatured finance charges. To get this, what we have to do, we have to prepare that amortization table, loan amortization table, correct? We had prepared that. So in that, we'll get the future or unmatured finance charges that we have to reduce. And then we have to reduce what? Depreciated value, correct? Depreciated value of the assets. We have to reduce depreciated value of the assets. How do we get the depreciated value? What is the method that we have to follow? Method of depreciation? Straight line method, percentage?
20%.
20%.
Very good. 20% straight line method. We get the depreciated value. The resultant figure is the provision to be created. Normal provisioning. Correct. Then next is additional provisioning. In case of additional provisioning, first thing we have to calculate is net book value, because additional provisioning are percentage on net book value. How to calculate net book value? Same procedure as we have calculated normal. First, we will have the total outstanding dues. From that, we will reduce unmatured finance charges. There, we reduce depreciated value, so we got provision. Here again, if I reduce depreciated value, there is no use. So I'll reduce the result of that previous calculation, which is the provisioning, normal provisioning. Once I reduce normal provision, the resultant value that I get is the net book value. Basically, net book value is nothing but that depreciated value. Correct? Net book value is nothing but depreciated value. Then, once I have the net book value in place, then I have to check for the period of default. If the default is for only 12 months, what is the provisioning?
Nil.
Nil, 0%. If it is beyond 12 to 24 months,
10% of net book value.
10% of net book value. 24 to 36 months,
40%.
40% of the net book value. 36 to 48 months,
70% of net book
70%
value.
of the net book value. Beyond 48 months, 100%. It is simple. From start with 10, add 30. 10, 40, 70, 100. Right? However, there is one small point there. If the last installment due date is also over, beyond that 12 months, if it is still due, then irrespective of in which category it falls, 100%. 100%, right? Very rarely it is asked, but these those up to 12 to 24, 24 to 26, 26 to 28, 28 to 30, the 26 to 30, 24 to 36, 36 to 48 and beyond 48 frequently asked in the exams. Simple, we have to just apply the percentage and get the answer. Even net book value they would have computed. We have to just apply the percentage and get the answer. Is that clear? Yes, these are the points that we had discussed in NBFCs, correct? We'll quickly look into the material if we have missed anything. Okay, this is banking. NBFCs, these things again, fine, no problem, not so important. Difference between NBFCs and banks can be asked, right? Difference between NBFC and banks. NBFC cannot accept deposits, demand deposits. NBFC do not take part in payment and settlement system, so they cannot issue checks to customers. And DICGC insurance is not covered for NBFC deposits. These are the four differences, right? Important, can be asked in the exam. Then next. Definition of own funds, net own funds is done. Again, requirement of minimum net own funds is not so important. Prudential norms with regard to income recognition, revenue recognition can be asked as a theory. Revenue recognition, normal rule is accrual basis. However, if it is classified as NPA, receipt basis plus unrecovered income till now should be reversed upon recognition of NPA. And interest income, dividend income, those things related income recognition points can be asked, so we might have to look into those points as well, right? These are the points within NBFC. Next, last chapter, dissolution. In dissolution, first we discussed about the normal dissolution, right? Normal dissolution, it is simple. First, realization account, all assets, all liabilities. Then asset realization, payment of liabilities, payment of expenses, realization expenses. With that, we get the profit or loss. that realization profit or loss transferred to partners capital in their profit sharing ratio. Now come to partners capital account, bring in the reserves, opening balance, whatever reserves they have. If they take away any asset or liability, account for the same and bring the realization profit or loss. With that, we'll get to know the amount payable or receivable from the partners. That would be adjusted to cash or bank account. Then open cash or bank account, opening balance we have asset realized, liabilities paid off, expenses paid off, amount recoverable from partners or amount payable to partners, cash account, bank account tallies by itself. Right? That is the normal dissolution. In case of dissolution wherein one partner is insolvent, first we have to check whether there is any agreement among them or whether there is something specified in the deed. If deed specifies, go with that treatment, else follow Garner versus Murray. Right? Garner versus Murray says realization loss, partners have to bring in their share of realization loss in cash, obviously solvent partners, and insolvent partners' share of loss, the deficiency should be borne by solvent partners in their
Capital ratio.
Capital ratio.
ratio, correct, in their capital ratio. Clear? That is what is there in insolvency of one partner. Then insolvency of two or more partners or all partners is simple, wherein we will not, in realization account, we'll bring in only the assets. Liabilities will be transferred to a separate ledger, either sundry creditors or liabilities account, right? Where in the realization account, we'll only realize the assets, pay off the realization expense. With that, we get the realization profit or loss, transfer it to capital. In partners capital account, obviously we will have debit balance since all the partners are insolvent. That debit balances would be transferred to deficiency account. Whatever extent of bank balance available after realization of assets would be transferred, would be used to pay the liabilities, obviously in that order of priority. Once everything is paid, the balance lying in the liabilities would be transferred to deficiency account. The deficiency account will match automatically. Correct? That is insolvency. That is the insolvency of all partners. Dissolution in case of insolvency of all partners. Apart from that, in dissolution, we discussed about
Piecemeal distribution.
Very good. Piecemeal distribution. In case of piecemeal distribution, when we are settling the amounts as and when received, we have two different methods. For what? These two methods are there for distribution of the amount among the partners. For distribution payment towards liabilities, it is the same order of priority that we have to follow. Whereas among the partners, we have two different methods: maximum loss method, highest relative capital method. In maximum loss method, that particular installment would be considered as the last installment, so that we get the loss. That loss would be apportioned among the partners in the profit sharing ratio. The resultant amount that we get, once we reduce that from the partners' capital, if they are positive, that is the proportion in which that particular amount of that installment would be paid to the partners. This exercise will be followed till the partners' capital reaches their profit sharing ratio. From there, we just we have to apply the profit sharing ratio. Similarly, in highest relative capital method, we will identify those partners who have higher relative capital when compared to their profit sharing ratio. We will pay off those excess capital that they have first. First, we will find out among the three which two has highest relative, among the two which one has the highest relative. From that, we'll pay off that particular partner's excess. Then we have two partners having highest relative, pay them. Then we will have all partners having the same capital in their profit sharing ratio. Using the profit sharing ratio, we will apportion the balance amount available. Right? That is highest relative capital method. Next, in this chapter, we discussed about LLPs. Right? Some small specific points with regard to LLPs. What is an LLP? Again, can be asked in the exams. Some theory questions can be asked. What is the nature of LLP? Difference between LLP and partnership firms, right? Then designated partners related liabilities, and when can the LLP be wound up by the tribunal circumstances. These are some of the points which can be asked. So we'll look into some of the points in the question, in the material. Yeah. So at dissolution, again, dissolution of partnership and dissolution of partnership firm are two different concepts altogether. Dissolution of partnership firm compulsory leads to dissolution of partnership, but the vice versa need not be the case. Correct? So in case of one insolvency of one partner, if deed is silent, then only we go with Garner versus Murray rule. What does Garner versus Murray rule say? It's given here. When all partners are insolvent, all the assets to realization, all liabilities, including partner's spouse loan, total creditors account, partner's loan directly to capital account, Then cash account we will pay secure creditors and other creditors. Balance in the total creditors transfer to deficiency. Balance in capital account also transfer to deficiency, which will tally by itself. Piecemeal distribution, we have maximum possible method and highest relative capital method. That's all. Amalgamation and conversion we'll discuss later. We have not yet discussed them in detail, right, in the regular class itself. So we'll look into it later. These are the 4 chapters that we had to discuss. Anyone has any doubts in this before moving on to the questions? We'll look into some of the questions, practical questions. Before that, anyone has any doubts in any of these that we have discussed? Everyone understood or over the head?
Understood, sir.
Okay, fine. We'll look into some of the questions. We'll start with those who are not yet serious about your exams, right? November 22, RTP has already been released, right? So we'll look into RTP questions itself, November 22 question itself. So first, dissolution of firm. Partners P, Q, and R have called you to assist them in winding up of the affairs of their partnership on 31st of December 2020. Their balance sheet as on that date is given below. Capital account P and Q are creditors, land and building, plant and machinery, furniture and fixtures, stock, debtors, cash and blank. Loan P and Q. P and Q are partners. Loan debit balance. Debit balance means receivable from partners. What do we do?
Adjust with capital.
Yes, adjust with the capital. Very good. Partners share profit and losses in the ratio 4:3:2. Cash is distributed to the partners at the end of each month. Summary of liquidation transactions are as follows. Jan 21, 9,000 collected from debtors, balance is uncollectible, 8,000 received from sale of entire furniture, 1,000 liquidation expense paid, 6,000 cash retained at the end of the month. So with that, we will get to know the amount that is available for distribution in January. February, 1,000 liquidation expense paid as part of payment of capital are accepted a machinery for 9,000, book value 3,500, 2,000 rupees cash retained in the business at the end of the month. Again, we will get to know the amount available for distribution. March 21, 38,000 received on sale of remaining plant and machinery, 10,000 received from sale of entire stock, 1,700 liquidation expense paid, and 41,000 received on sale of land and building. No cash is retained in the business. Whatever is remaining, ultimately final installment in March we will be distributing. You are required to prepare a schedule of cash payment amongst the partners by higher relative capital method. We have solved similar problem. In that second month, we had takeover of equipment only. Here we have takeover of machinery. Same, basically it's the same adjustments, right? We'll quickly look into the answers. We'll not go in detail because we have already solved this type of problem. Creditors and capital are the liabilities that we have. This is after adjusting partners loan. Now, January 9,000, 10,000 is the realization less expenses and cash retained. So 19,000 is available. How did we get 16,000 and 3,000? Working note. So partners capital loans, this is the capital, this is the profit sharing ratio. We'll divide capital with the profit sharing ratio to get the base capital. This is the base capital, 13,000 into 4, 13,000 into 3, 13,000 into 2, we get 52, 39 and 26. So 43,500 minus 39, 4,500, 32 and 26, 6,000. This is the excess capital of Q and R. Again, further 3 and 2, 1,500 and 3,000, correct? 1,500 is the base capital, 1,500 into 3, 4,500, 1,500 into 2, 3,000. So 4,500 minus 4,500 is 0, 6,000 minus 3,000, 3,000 is the excess capital. So we have how much? We have 19,000. Out of 19,000, first 3,000 to R. Right? Okay, 19,000. First we have to pay creditor 16,000. We'll get only 3,000 remaining. That 3,000 remaining entire to R. Right? Similarly, next installment we had 6,000 expenses, realization expense 3,000. Available cash distribution is only 3,000. So in that 3,000, how do we get that? 52, 40,500, 32,000. We paid how much? We paid 3,000 in the first installment, and he took over 9,000 machinery. 9,000 he took over the machinery. So once he took over the machinery, his balance is only 20,000. Correct? Now again, if we further calculate the relative capital, we get 3,000 to be paid to Q, and with that 52,000, 4,500, 20,000. Further, we get 41,689, 32,677, 14,844 as the amounts payable to the partners. The balance amount is the loss. Right? This is highest relative capital. Next is LLP. Can a partner be called upon to pay the liability of the LLP? No, it is limited liability. But if the partner is involved in fraud, If there is a fraud and he is the person who is involved, then he will have unlimited liability. If yes, under what circumstances? Basically talking about that unlimited liability scenario, fraud. Under section 27(3), any obligation of LLP arising out of a contract or otherwise shall be the sole obligation of the LLP. Partners of an LLP in the normal course of business are not liable for the debts of the LLP. Liabilities of the LLP shall be met out of the assets or properties of the LLP. However, a partner shall be liable for his own wrongful act or commission, but shall not be liable for the wrongful acts or commissions of other partners of the LLP. Wrongful acts will include act of fraud, willful omission, etc. Hence, liability may fall only on that partner who is guilty of any wrongful act or commission in respect of debts or liabilities. Next, question number 3. Esop. Mehta Limited grants 1,500 stock options to its employees on 1/4/2019 at 50 rupees. So what is this 50 rupees?
Exercise.
Yes, exercise price. Very good. The vesting period is 2.5 years. Maximum exercise period is 1 year. Market price on the date is 80 rupees. Fair value of the option is 30 rupees. All the options were exercised on 31st of July 2022. Give the necessary journal entries if the face value of the shares is 10 rupees per share. So in this case, even though they have given 80 and 50, we need not calculate 80 minus 50 because 30 rupees fair value they have already given. Even if it was 40 rupees or 45 rupees, we should still go with this only, not 80 minus 50, since they have given us fair value. Now, the total number of options, 1,500. So here we are not bothered about lapsing, etc. Why? Because all options are exercised. So it's simple. 1,500 options into 30 rupees. Correct? This is the total expenses. Divided by 2.5 will give the amount to be recognized, expense to be recognized every year. Since this starts at the beginning of the year, in the first year, full financial year we have to recognize. Financial year 1920, full year. Financial year 2021, full year. And financial year 21-22,
half.
The balance 0.5 we have to recognize, right? These are the journal entries that we have to pass. Once again, after, on 31st of July, we have to receive the money, 50 rupees from those employees, and then we have to allot the shares. That's all. What are the entries that we have to pass? Have they given us the calculation? Yeah, 80 minus 50, 30 into 1,500, 45,000. 45,000 into divided by 2.5 is 18,000. 18,000 and 0.5 is 9,000. Right? Employee, the entries we should not use, we should use the same terminologies. Employee compensation expense account debit to ESOP outstanding account, P&L account to employee compensation expense, employee compensation expense to ESOP outstanding, P&L to employee compensation expense, employee compensation expense to ESOP outstanding, P&L to ESOP employee compensation expense. Then receipt, bank account debit to equity share capital account to securities premium account, because 50 rupees, 40 rupees is securities premium out of 50. Then stock ESOP outstanding account debit to securities premium, balance in ESOP outstanding account transfer to securities premium. Now that ESOP outstanding should be okay. Instead of doing that, we can merge these two entries. That is what we do. No, bank account debit 50 rupees, then ESOP outstanding account 30 rupees, to equity share capital 10 rupees, to securities premium 70 rupees. That is what we would have done, one single entry. Here what they have done is 40 rupees here, 30 rupees here. Total securities premium has been credited by 70. Entry is correct, but we can merge these two. We can merge those two. Okay, that is ESOP. Next, buyback. Umesh Limited resolves to buy back 4 lakh of its fully paid equity shares of rupees 10 each at 22 rupees per share. This buyback is in compliance with the provisions of Companies Act and does not exceed 25% of the paid up capital in the financial year. Here they have given us, we have no confusion. For the purpose, it issues 1,11% preference shares of rupees 10 each at par. The entire amount being payable with application. Company uses 16 lakh of its balance in securities premium apart from its adequate balance in general reserve to fulfill the legal requirements regarding buyback. Give necessary journal entries to record the above transaction. First, we have to allot the shares, preference shares, 11% preference shares of rupees 10 each, 1 lakh shares. So 1 lakh into 10 rupees, 10 lakhs is the amount that we are receiving. Everything is received at the time of application itself. Right? So 11 bank account debit to 11% preference share application account, 11% preference share application account debit to 11% equity share preference share capital account. Then we have to pass buyback due entry by equity share capital account 4 lakh into 10 rupees, securities premium account or premium payable on buyback account 4 lakh into 12 rupees to equity share buyback account. Then after that,
Payment.
before payment, we will create CRR. Yes, we have to create CRR. We will create CRR. With regard to creation of CRR, what have they given us? They have said you can use 16 lakhs in securities premium, balance use general reserve. So what is the amount of CRR to be created?
4 lakh.
40 lakhs.
40 lakh.
40 lakhs is the nominal value, but out of 40 lakhs, we have already issued 10 lakhs preference shares.
Yes.
So only 30 lakhs is the extent to which CRR to be created. Out of 30 lakhs, 16 lakhs you will use securities premium, balance 14 lakhs I will use general reserve.
General reserve.
Right, general reserve. Once that is done, yes, you can pass payment entries. Then we should not forget write-off of premium.
Premium.
Payable and buyback. Since securities premium is already used, you can use general reserve to write off the same. Okay, these are the entries. Bank account to preferential application to preferential capital, general reserve to CRR, 30 lakhs, entirely 30 lakhs you can create from general reserve itself. Equity, because 48 lakh is the premium payable on buyback, so you can utilize out of 48 lakhs, 16 lakhs you can utilize securities premium. Both are fine. Securities premium can be used to create CRR also, to write off premium also. So either way you can solve this. To equity shareholders or equity share buyback account 88 lakh, equity share buyback to bank account, and securities premium general reserve to premium payable on buyback 48 lakh. Simple. Right. Next question. Equity share with differential rates. What is meant by equity shares with differential rates? So we have to explain. Equity share with differential rate means the rights, it's a equity share different shares with dissimilar rights or differential rates as to dividend, voting, or otherwise. Right? Just this is the only definition available. So beyond that, since obviously one marker will not be asked. It could be a 2 marker. This could be 2 marks, and this could be for 3 marks. Total 5 marker question. In such cases, we might have to write one more point. What we can write? Total share capital divided into 2 equity share preference shares. Preference shares, differential rates cannot be there. In equity shares, we can have 2 different categories. We can write that particular point as a filler. Okay, next. Equity shares with differential rights, L, M, N, and O hold equity shares, equity share capital. Is the question visible?
Yes.
Okay. Element and O hold equity share capital in the proportion of 30-30-20-20 in AB Limited. X, Y, Z, and K hold preference share capital in proportion of 40-30-20-10. You are required to identify the voting rights of shareholders in case of resolution of winding up. In resolution of winding up, even preference shareholders have the right to vote. Correct? Paid up capital of the company is 80 lakhs and preference share capital is 40. So this is paid up equity capital should be. Question is incomplete there. So if equity capital is okay, answer is visible.
Yes, sir.
Okay, fine. Now the question is visible.
Yes, sir.
Okay, so here paid up equity share capital 80 lakh, preference share capital is 40 lakhs. So 2/3 and 1/3 is the proportion weightage that I have to give to equity shares and preference shares. So equity shares we have 30-30-20 and 20. 30 into 2/3, 20% is the voting weightage given to L, right? Similarly, 20 into 2/3, 40/3 is the weighting given to N and O. For 40-30-20 and 10, 40 into 1/3, 30 into 1/3, 20 into 1/3, and 10 into 1/3 is the percentage of weightage given to preference shareholders. Is that clear?
Yes.
Yes.
Now, is the answer visible now?
Yes.
Yes.
Okay, right. So 2/3 into 30/10, 2/3 into 30/100, 2/3 into 20/100, and so on. That is what we have to do. This is equity shareholders. So 2/3 is the weightage, is preference shareholders. So 1/3 is the weightage. That's all. So these kind of questions can be asked. Then last question of NBFC, question number 9. XYZ Finance Limited is a NBFC. Extract of its balance sheet as follows. You are required to compute net owned fund of XYZ Finance Limited as per NBFC systematically important non-deposit taking company and deposit taking company Reserve Bank directions 2016. So to calculate net owned funds, First one, paid up equity capital, do I have to consider?
Yes, sir.
Yes. General reserve?
Yes, sir.
Yes, because it's a free reserve, right? Then loans, deposits?
No, sir.
No.
No. Property, plant and equipment? No. Investment in shares and debentures? No. To calculate net own funds, I will not require that. Current assets and cash and bank balances is also not required. So 800 is the own funds. From
Yes.
that, I have to reduce something. So here, shall I consider shares of subsidiaries?
Yes, sir.
Shares
Yes.
of debentures of group companies?
Yes.
Not.
Yes.
Debentures of group companies also should be considered. This adds up to 650. Out of 650, I have to subtract
Minus 8.
80, 10% of the own funds. So the excess is 570. This 570 I will reduce. I'll get 230 as the net own funds. Clear? This is how
Yes,
we
sir.
calculate net own funds, right? So that is, yeah. So we get question number 9. I'll just show you the answer. Yeah, 230. 200 plus 600, 800, 250, 400 is 650, 650 minus 80, 570, 800 minus 570, 230. That's all. So these are the questions from these chapters that we have discussed in November 22 RTP. We'll go one RTP back next 5 minutes. Quickly, we'll discuss. Okay, fine. This is May 22 RTP, but I don't think so. This is no. Okay, this is group 1. Just a second. I'll open. Okay. The firm of Messrs. Ohm has 4 partners, A, B, C, D. And as of 31st March 21, its balance sheet stood as follows. Capital accounts ABC, current accounts ABC, loan from NBFC, current liabilities, land, building, office equipment, computer, data, stock, cash at bank, other current assets, current account of D. Partners have been sharing profits and losses in the ratio 4:4:1:1. It has been agreed to dissolve the firm on 1/4/2021 on the basis of following understanding. Following assets are to be adjusted to the extent indicated with respect to the book values. Land 200%. Building 120%, computer 70%, data 95%, and stock 90%. These are the realizable values, right? Then in case of the loan, lenders are to be paid at their insistence a prepayment premium of 1%. What is this? What do we understand by prepayment premium?
Discount.
Is it discount? It says premium.
Discount received, sir.
We have to pay premium.
Yes, we have to pay premium. In case of prepayments, certain banks ask for an additional payment of premium. Why? Because they are losing interest, right? As a compensation for it, they'll ask us to pay. So here on the loan amount, NBFC 5 lakh, we have to pay 1% extra. D is insolvent and no amount is recoverable from him. His father C is also a partner here. Should not forget. His father C, however, agrees to bear 50% of his deficiency. Balance of the deficiency is to be agreed to be apportioned according to law. What is law?
Capital ratio.
Capital ratio.
Capital ratio. Very good. Capital ratio have to be followed. Capital ratio balance. So out of the total deficiency of partner D, 50% would be contributed by partner C. Balance between partner A, B, and C in their capital ratio. Right? Then assets are realized at agreed or adjusted values, assuming that realization of assets and discharge of liabilities is carried out immediately. Show cash account, realization account, and partners capital account, including their current account. Simple. Clear with this? Yes.
Yes.
We'll quickly look into the answer as well. Yeah. So balance brought down, realization, that is all those assets. Then payment of liabilities. Sorry, this is cash account. The realization account, bring in all the assets, bring in all the liabilities, cash. Remember, based on the percentage that they have given us. Then payment of liabilities, NBFC loan was 5 lakh plus 1%, 5 lakh 5,000. Then other current assets. So basically we are left with profit. Here is realization profit apportioned in the ratio of profit sharing ratio. Since it's a realization profit, even though we are applying Garner versus Murray rule, they need not bring in their share of realization loss in cash because it is realization profit. If there is realization profit, firm will not pay the partners. Only in case of loss, solvent partners have to contribute, right? Then balance brought down, capital, then current account balances, then realization profit, then you have the deficiency of partners D. 42, we have total deficiency of 85,000. 50%, 42,500 is borne by partner C. Balance 42,500 in the ratio of 2:2:1. That is why we get 17,17 and 8,500. 17,000, 17,000, 8,500. Then the balance amount to cash account, that is final settlement. Final settlement among the partners. Then partners current account. Partners current account, anyhow, we have already brought in realization loss. Then transfer to partners capital. That's all. Next question. Next question is question 1B. Explain the nature of LLP. So we have to bring in all the characteristics. It has perpetual succession, separate legal entity, limited liability, those properties that we have, characteristics. Those characteristics we have to explain. Under what circumstance an LLP may be wound up voluntarily or by the tribunal. We have various circumstances, right? Voluntary winding up or winding up by the tribunal. Those circumstances we have to look into. LLP, this is nature of LLP answer. LLP is a body corporate formed and incorporated under LLP Act 2008 and is a legal entity separate from that of its partners. A LLP shall have perpetual succession and any change in the partners of LLP shall not affect the existence, rights or liabilities of the LLP. Under LLP Act 2008, an LLP may be wound up voluntarily or by tribunal, and such LLP so wound up may be dissolved. LLP may be wound up by tribunal in the following circumstances. If LLP decides that it should be wound up by tribunal, if for a period of more than 6 months, number of partners is reduced below 2, correct? LLP is unable to pay its debt. LLP has acted against the interest of the country, India. LLP has defaulted in filing of statement of account and solvency for 5 consecutive years. And if tribunal is of the opinion that it is just and equitable to wind up the LLP. That's all. These are the points that we have to write. So we have to remember some of the points there, at least 5 marks, no? 5 points. Then question number 3, accounting for ESOP, define the following terms: vesting, grant date, and exercise price. You have to define them. Then Noor Limited has its share capital divided into equity shares of 10 each. On 1/1/2021, granted 4,000 stock options at 40 per share when the market price is 60 rupees per share. Fair value is 20. They themselves have given. Options were to be exercised between 15th March and 31st March. Employees exercise their options only for 2,500 shares and remaining options lapsed. Company closes its books on 31st of March every year, required to give journal entries with narration as would appear in the books of the company for the year ended 31st March 2021. So everything happened in the same financial year. So as on 31st March itself, we'll pass those expenditure entry and allotment, receipt entry and allotment entry. Only 3 entries that we have to pass. Employee stock option outstanding, ESOP outstanding account will never come into picture. Right? Simple. Next question. Buyback of securities. Complicated limited unlisted company gives the following information. So these are the information that they have given us. Company wants to buy back 25,000 equity shares of rupees 10 each on 1st of April 2021 at rupees 15 per share. Buyback of shares is duly authorized by articles and necessary resolution have been passed. Buyback is also within the provisions of the Companies Act. Again, they have specified. Payment for buyback of shares was made by the company out of sufficient bank balance available, shown as part of current assets. You are required to prepare necessary journal entries towards the buyback and prepare balance sheet after the buyback. So simple. Buyback due entry, buyback creation of CRR, then write-off of premium, payment entry. Only these 4 entries that we have to pass. Apart from that, we have to prepare balance sheet after buyback. Simple. Then explain the conditions for equity shares with differential rights under the Companies Act rules. That rule that we discussed, right? Rule 12. That we discussed that it should be authorized by articles, 26% of post issue, right? Maximum. So those points we have to bring in. Then next one is again same. LM and O hold equity share capital 30/30/2020. XYZ and K hold preference share capital 40/30/20 and 10. Required to identify voting rights of the shareholders in case of resolution of winding up of the company. If paid up capital is 60 lakh and preference share is 30 lakh, so 60/30. 2:1 again, 2/3 and 1/3 is the weights that we have to allow to equity shareholders and preference shareholders. Same proportion. Yes, Pawan.
Sir, is there any disclosure for a buyback in notes to accounts?
Buyback, no disclosure.
Yes, sir.
Then calculate owned funds of an NBFC. They have given us, should I consider paid up capital?
Yes, sir.
Yes.
Yes, sir.
Again, we are presuming it to be equity share capital. If it is preference share, only CCPS should be considered. Free reserves?
Yes.
sir.
Yes. Oh, now CCPS. So this should be equity then. CCPS?
Yes, sir.
Yes, sir.
Yes, sir.
Revaluation reserve?
No, sir.
No, sir.
No. Securities premium?
Yes, sir.
Very good. Yes. Securities premium. Yes. Book value of intangible asset 10 lakh. What should I do?
Reduce.
Reduced. Correct. Capital reserve surplus arising out of sale proceeds of assets 15 lakh.
Add.
Add.
Consider. So with this, I'll get own funds. You're asking only own funds, not net own funds. Right? So simple calculation. Next, they have given us standard, substandard, doubtful, unsecured, a portion of doubtful and loss assets. We have to create amount of provision. We have to calculate the amount of provision based on the percentage that we know. Now for standard asset, what is the percentage that we have to take here?
0.25.
0.25.
Very good. 0.25 because this is not systematically important, non-deposit accepting NBFCs, right? That is the key. That's all. These are the questions which have been asked. So with that, we have looked into fairly all the questions that we have discussed, right? So everything were covered, yes, except I think maximum loss method we didn't discuss. The question we didn't go through. Anyhow, those questions we have already solved in the class. Now, fairly we have understood what we have discussed, right? Yes?
Yes, sir.
Yes. Okay. So with that, we are done with those 4 chapters. Thank you. Anyone has any doubts before that? Anyone has any doubts? No doubts. I understand you have a class at 7:30. Enjoy. Thank you. Yeah,
Thank
okay.
you.
Pawan.
Thank you.
Yes,
Sir,
Pawan.
what is big NBFC and small NBFC? Sir?
Simple. All deposit accepting NBFCs are big. Non-deposit accepting NBFCs, in that systematically important, will be classified as big NBFCs. Non-systematically important, small. Why that big and small? We should not write it in exams, right? It's only for our understanding. Big NBFC, why we classify them as big and small is for deposit accepting and non-deposit accepting systematically important. They have one set of regulations. For non-deposit accepting, non-systematically important NBFCs, they have a different set of regulations. Similarly, the provisioning 0.25 is only for non-systematically important, non-deposit accepting. 0.4% is for both deposit, non-deposit, systematically important. Yes, but in exams, we cannot write big and small. We have to write the respective names, and we need not bother in the question itself. They would have given. We have to just copy paste.
Yes, sir.
Yes. Thank you.
Thank you, sir.
Thank you, sir.
Thank you, sir.
Sagar.
Don't play, man.